Doing great. How are you, Kirk?
Yeah, doing well. I'm calling here from not so sunny New York City. I think we got a couple callers in from New York City. Where are you dialing in from?
I am joining from not so sunny Chicago, Illinois.
Oh, very nice. I was actually just in Chicago this last weekend. I had a friend's 30th and he brought all the boys in and we went out to it was called it's the Jose Andreas restaurant. I forget. It's like the one that
Oh,
put him
there's a
on the
bunch
map
of them.
downtown.
There are a bunch of them.
Starts with a B, I think.
B. Bar Mar is one of them.
Barmar
Is
was
that what
right
it
next
was?
door. That was the
Oh,
one next
okay.
door. Here, we're gonna
Okay.
have a
I'm
full
not sure.
master class on Chicago restaurants today.
Yes. You're never going to run out of options. I think we've got over 10,000 restaurants or something crazy.
And they're all spectacular. Chicago's a phenomenal city. Well,
Yeah, that's
if you
amazing.
are dialing in from an amazing city, definitely put it in the comments. We want to see where everyone's coming from here. All the resources here today as well. Some of them will be shareable. We'll show you this at the end. So we definitely want to hear from you guys as you're dialing in from different places, time zones, these sorts of things. Today is in my opinion, the hardest type of modeling that we're going to go over. That's cash flow forecasting. Logically, it seems very simple. But updating it, very difficult. The source systems, the users. Luckily, though, we are joined by none other than Carl himself. He needs no introduction at all. You've Anybody that's on this call, you've likely seen him before. He not only consults but teaches about financial modeling and all and everything accounting and finance. Today, I get the pleasure of hosting him, and he's going to walk us through some amazing stuff on cash flow modeling, some of which I've seen, some of which I haven't, and so some of it is new. Carl, thanks so much for coming.
Kirk, thank you for having me. As Kirk highlights, first of all, what I love is we've got people from all over the world. I see Chicago, I see Los Angeles, I see Colombia, India, Dallas, Cleveland, another one from India, Boston, Switzerland, Arizona, and more. As Kirk brings up, cash flow modeling and forecasting is obviously one of the most important tools and abilities that anyone can have at any size company, whether you're talking a startup, a mid-market company, a Fortune 500, and every industry. But the challenge is, as Kirk brings up, is most people are very accustomed to doing what I'll call just the indirect format of cash flow forecasting, which is your operations, your investing, your financing, and we'll talk about that in just a moment. But when we really want to get a good grip on cash flow, we really want to be spending our time on the direct. The direct, which I'll talk about for most of the time that we're going to spend together, is just simply cash in and cash out. And some of you on this program might say, well, how difficult is that? It's actually a little bit more nuanced and challenging than most people think. So that's what this program is going to be all about. I do encourage you to stay to the end so that you can get one of my resources, a template that you'll be able to start implementing right away. A lot of people who I've given it to have said, you know what, it's good for me to get started. And then some people will respond 2 months later and they say, we just built out our entire direct cash flow forecast using that template. So without any further delay, let's advance to a first poll. And this poll will, perhaps assess you and understand what are the challenges that you have. So I'm going to ask you, what are your biggest pain points when it comes to cash flow forecasting? Not necessarily indirect or direct, but overall, manual gathering of data that it takes too long. The forecast is outdated very quickly, which is often the case. Difficulty modeling the different scenarios rather than marrying yourself to one set of assumptions, or being able to or not being able to dive really deep into the detail. What do you think?
These are some good questions here, Colin. I've seen a lot of people answering this. Right now, I'm not sure if you can see this, but let's say 15 out of the 30 people that have answered say difficult modeling different scenarios. So scenario
Mm-hmm.
management seems to be a killer there. Another one I'm seeing here, how confident are you in your cash flow? Somewhat. We're getting kind of the middle of the range, but it's leaning towards not very confident. It's only we only got 1 out of 37 that's very confident. That might have been your own response. Maybe you did that.
It wasn't me. I stayed out of this poll. All right. So not
Yeah.
surprising, taking a look at all this, the reason why we have all of these different options is everybody struggles with a lot of this to some extent, some more than others. but obviously you're all in good company, and this is hopefully going to be a great place for you to learn.
Before we jump
Oh,
on here, Carl, really quickly, I'll just tell everybody, if you guys have questions as Carl's going through, shoot them through. I'll be keeping an eye on them and I'll jump in as needed. We'll also have a Q&A at the end for a bit deeper Q&A analysis, but more participation is better. And so without further ado, Carl, all yours. Take us away.
you bet. Okay. So what I'm going to do here is I'm going to share just a handful of slides, give you a little bit of foundation, but I promise you that the bulk of everything that we're going to be covering today is very hands-on, very real-life application ready. So to begin with, what does a cash flow structure look like? Most of you, not just many, but probably most of you are very familiar with the indirect method. As I had said at the very beginning, you've got your three core categories: your cash flows from operating activities, your cash flows from investing activities, and then your cash flows from financing activities. Operations oftentimes really speak for themselves, but for the most part in this cash flow statement, it's a reconciliation of movement on the balance sheet as well as adjustments to net income, oftentimes for non-cash items like depreciation. In the investing activities, if we're talking about a product company, or industrial manufacturer, we're often talking about investment in fixed assets, disposal of fixed assets. And then on the financing side, we're often talking about raising or paying off of debt as well as equity. Now, one of the challenges that many people have when they're doing cash flow modeling is they say, oh, well, I'm going to do an indirect. This is easy, right? I have a P&L, I have a balance sheet. Calculating this is basic math. But the problem is you actually don't get to see all of the details of the cash movement within these categories. And if I can give you an example, I sometimes share this with the groups that I work with is if you start at $2 million of accounts receivable and you go down to $1 million in accounts receivable, 2 million down to 1, what does that mean? You collected $1 million worth of cash, right? Not necessarily. The math makes sense. But what's likely also happening is that AR balance is going up because of your credit sales. And then it's going down because of your cash collections. So the indirect method, I often just say, commingles a lot of activity and it doesn't give you the visibility that a direct does. If we come over here to the direct, as I had mentioned in the introduction, it's really basic in terms of the concept. It's just cash receipts and cash disbursements, cash in, cash out. And if I break this down to say, well, what is cash in? Well, we've got collections on trade AR. You could have proceeds from debt. You could have government grants. You could have certain cash refunds. So this is just positive cash coming in and hitting your accounts. And then on the cash disbursement side, obviously, these are all cash outflows. We've got our cash payments on accounts payable, payments on accrued expenses like professional fees or utilities, prepaids like, let's say, prepaid software. It could be rent, it could be insurance, payroll, obviously, CapEx, interest and debt payments, professional fees, and a lot more. And then obviously, the calculation gets us to net cash flow, which then reconciles between beginning and ending cash. But you might even be taking a look at this and saying, well, I only have two categories. It's just cash in, cash out. Well, I have a lot of different types of cash coming in. I have a lot of different cash going out. This doesn't give me the kind of visibility I want to see either. So what do? We break it down even more. And this is what you're going to see in the cash flow model that we're going to be going into in just a few moments. Operating cash receipts, again, this is trade AR. Operating cash disbursements, payments on AP, accrued expenses, prepaids, and payroll. That's it, just in terms of arriving at operating cash flows. Now, why do we do something like this instead of something that's seemingly more simple? Because I actually want to see what my cash flow from core operations of the business are, ignoring my CapEx, which may be discretionary, ignoring my interest, ignoring my principal payments, which, if I have enough organic cash, I might not need debt service. So we break this out into the way that is most meaningful for us and for our end users. And then finally, of course, this gets us down to net cash flow, and we can reconcile this from beginning plus or minus the net cash flow gets us to the ending. Again, if any of you have any questions, please feel free to type them into the chat window or into the Q&A. And again, Kirk is going to field them and interrupt me at times if there's something that's really good that we want to talk about.
Well, one thing
All
I
right.
love that you've just said, Carl, is that the indirect method will capture the net, but you can't split out what the increase or the decrease was. But the direct method, with that AR example you're giving, will capture what truly was the increase in cash and what truly was the decrease in cash. You can then net it, of course, yourself by seeing the net cash movements, but at least you get the detail behind it as well. That alone tells you why, operationally at least, you need the direct method.
Right. And if I could take that one step further, in that very last sentence you said, Kirk goes, operationally, you need the detail. If you're a finance person and you're just saying, let's analyze financial statements, great, use the indirect. But if you are getting really hands-on in your business or in your client's business or in your portfolio company, you're going to be taking a look at finance, not just from financial statements. You're going to be really managing the operations, scenarios, drivers, opportunities, and issues that you have in your business. Okay, so one last point, and then I promise you, we're going to get right into the model and we're going to be going line by line through some of these pieces that are most meaningful. So, when it comes to the structure of a weekly cash flow, I'm going to make this disclaimer here and call it a 13-week cash flow. Well, why 13 weeks? I want you to think about how many weeks there are in a year. There's 52. 13 divided by 52 is 1/4. So the reason why the 13-week cash flow is often what I call the gold standard in finance and accounting is it reflects a very common reporting cadence. If we wanted to break out a full year into quarters, obviously we've got four of them, and we could have four different 13-week cash flows. And then, of course, if we wanted to roll this thing forward, we can roll it forward 1/4 at a time. Now, I'm also going to say part of the reason that the 13-week is the gold standard is not just because of the quarterly cadence, but also the benefit of the granularity. I sometimes ask people a personal question. I say, maybe Kirk. I say, Kirk, how confident are you in what your personal checking account balance would be next week? And Kirk, I'm actually going to ask you that question, not rhetorical. Next week, do you think you have a high degree of confidence in what your balance would be or a low degree of confidence?
I'm gonna say if you amalgamate everything, I'm gonna have a 40% confidence rate. If
Okay.
to the nearest thousand.
Okay, so pretty decent. But Kirk, if I'm going to say, what about 52 weeks from now? Do you know what your ending balance is going to be? Is it going to be
0% chance.
0% chance, right? So the whole point of weekly cash flow forecasting is be able to do this in the near term because that level of detail is going to keep that level of confidence high. And to Kirk's point, is if I'm forecasting 26, 52 weeks out, the confidence level of doing that is very low. Now, when you take a look at the layout, obviously we've got our cash receipts, we've got our cash disbursements. This gets us to our net cash flow, and we reconcile like a corkscrew, as you would see down here on the bottom. But I'm also giving you a little bit of a clue. Month number one, month number two, month number three. So each one of these weeks corresponds to month one, month two, month three in a monthly cash flow, which then means if we ever wanted to consolidate or aggregate a weekly cash flow with a monthly and with a quarterly and then to a yearly, this is already stacked up and positioned to do that. And this last visual I'm going to share with you here is this is what that integration looks like. When I work with my advisory consulting clients and they say, yeah, we need help on the weekly cash flow, I say, great, but what about long term? So what starts out as a cash crisis turns into, okay, now we have staved the bleeding, we're turning the company around, but what's the long term plan? So if you're only focusing on the weekly, you then miss out on all of this runway to the right. And if we can consolidate these things together, tremendously meaningful. Okay, now with that, probably the moment that many of you have been waiting for, let's go through the model. So this is just one of my cash flow models. Again, this is a weekly, 13 weeks. But what you're also going to notice is I have some very interesting, what I might call notations up above, is you can see that we have 13 weeks of forecast. We have the week beginning September 1st to September 8th to September 15th, etc. These are 7-day increments. Also, here at row 9 and row 10, we have what I might call date tags. Now, I'm going to put my cursor right here on row number 9, and you're going to see September, 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 month ending September. October, 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 month ending October. November, 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 month ending November. Now, before I continue, I just want to point out here is when you see these month ends, you might say, well, hold on a second. This isn't September 22nd, October 27th, November 24th. It's the week beginning on those dates. So, what this tagging allows us to do is to start positioning this weekly cash flow for monthly and quarterly timing. So, I can come over here, as you'll see, and I can use simple formulas to say, let me take a look at all of the activity for September, all of the activity for October, all of the activity for November, and bring that in here. And when I go down, you're going to see every single line, every single piece of detail that connects a profit and loss statement and a balance sheet to the weekly cash flow. And so using this consolidation, I can grab all of my detail of the weekly, I can get my month end balances, and I have an effective consolidation. Okay, now before we start getting into all of this, I'm also going to open up here to the left. We have our actuals. Now, why would I include actuals? Because I want to be able to build off of, to springboard off of my prior balances. If you take a look here, I have AR collections. Well, I need to know what's in my AR outstanding. If I have payments over here on materials, I need to know what I have in my AP outstanding. Payroll, I need to know what my accrued payroll is. Marketing, I need to know what my accrued marketing expenses are, and so on. At the same time, I caution anyone who's doing cash flow forecasting to not just start out of the gates with no track record. If you have no historicals and you have no trends, you have to come up with those yourself. You have to come up with your new assumptions. But if I can take a look backwards and say, well, this is what collections have been previously, this is what payroll was previously, this is what utilities were last month, I can then use those as a foundation for my assumptions going forward. Okay, so what I'm going to suggest here is let's take a look at this entire thing. I'm going to bring your attention here, cash receipts, cash disbursements on the operating side, net cash flow from operations. So if you remember from my slides, I gave you two different versions of the direct cash flow. The first was cash in and cash out. The second was cash in from operations, cash out from operations. This is what you see here. So if I sit down with Kirk and Kirk says, Carl, how are we doing from an operational standpoint? I can point him right over here and say, Kirk, for the quarter ending November, we have $620,000 in operating cash flow. Now, what I'm often doing in my head when I take a look at these cash flows is I'm doing pro rata forecasts. I'm saying, well, $500,000 or $620,000. Let me multiply that by 2. That gets me to 1.2. 1.2 times 2, that gets me to 2.4. We're about a $2.4 million cash flow from operations business. So then I ask myself, I say, well, is that good? Is that bad? What does that mean? And what I'm going to do real quick, and some of you accountants in this room are not going to like what I'm going to do here, but bear with me, is I'm going to go equals cash flow from operations divided by accounts receivable. Now, why am I doing this? And why did I just say you accountants probably won't like what I just did? Is I'm almost treating AR like it's an indication of sales. Okay? So this is a $14 million company, at least in the 13 weeks. I'm going to take this, multiply it by 4. Let's make this a little bit smaller so we can see. We're about a $58 million company. But if I take this amount of cash divided by this amount of revenue, or this amount of profitability on the operation side, This is only 4%. So this is already striking to me of saying, I think we've got some issues over here on the operating side. What about non-operations? When I come down over here to capital expenditures, now some of you listening to me are saying, why would you put CapEx down there? Isn't CapEx an operating expense or operating cash flow? Well, we have two different types of CapEx. We've got maintenance, which just might be recurring, and then we have investment CapEx. If you take a look right here, I have maintenance CapEx in my operations, just keeping the wheels on the bus. But down over here, you're going to note that I have $1 million of additional cash out, which seemingly is related to some kind of a major investment. Obviously, we've got taxes, we have debt service, and then this takes us down here to cash flows out from operations. Finally, when we come down here, you can see the reconciliation, beginning cash to ending cash, adjusted by net cash flow. But what do you see right here? If you look closely, you might say, well, wait a second. Beginning cash is zero, ending cash is zero. How could that be? Because if we take a look right here, we are floating this company from a liquidity standpoint through a revolving line of credit, short-term financing. The reason why I often do this instead of showing, a cash balance going up and down is if this company is already floating itself on short-term borrowings, I want to be able to see throughout my forecast what those borrowing needs are. So in this case, as I highlighted, this company is already not doing great on the operation side. But when we factor in CapEx, taxes, and debt service, this company is in a lot of trouble. And not only do they have negative 1.1 million in net cash flow, they need to be able to plug that with additional borrowing. Okay, now what I'm going to do is I'm going to take us all the way down to those borrowing needs. And my guess is when you take a look at this, your eyes are already popping because I have some conditional formatting in here that shows where we have some issues. Right now, I'm making the assumption that we began, at least at the beginning of August, with $3.5 million drawn on a $5 million line of credit. Well, as we start to take a look, this is going down, it's going up, it's going up. And then as soon as week number 3, we start going above that 5 million. So one of the reasons why we put this together in the first place and why clients call me in to say, I think we're in trouble, is if we are 3 weeks out from blowing through the total availability on the revolver, we either need to do some kind of an operational restructuring or we need to go to the bank and potentially ask for more money. And as you can see here, well, we do go to 1.5. It doesn't look like it goes any higher than 1.8. Rather than going to the bank and saying we need to extend to 6 million, what can we do operationally to bring this back? Okay, so what I'm going to do is I'm going to take us all the way up here to what I commonly refer to as the roll forwards. The roll forwards are just simply reflective of accounting equations. Let's talk about perhaps one of the most important and perhaps one of the most misunderstood. When I come over here, this is the accounts receivable roll forward. We begin at 6.1 million. We have additional sales that are coming in, increasing that balance. We also have receipts on existing accounts receivable, and then we have receipts on new sales. So let's go back to the discussion on indirect cash versus direct cash. Remember what I was doing with Kirk of saying, Kirk, if I go from 2 million down to 1 million, it seems like I've got collections of cash of 1 million. And Kirk correctly said, well, it's kind of your net impact, right? It's after the increases of your credit sales as well as your collections. But everyone take a look here is I have appropriately segmented. These are my sales. These are my collections. But in addition, the collections are further segmented by the two factors of I have sales that have already taken place that I need to collect on, and then I also have new sales taking place in the future that I need to collect on. If I
So I've
bring
got
them
a
both
question
together,
here for you, Carl.
yeah,
Oh,
go
sorry,
ahead,
go
Kirk.
ahead. I was going to say this. What's the best way to distinguish between receipts on aged AR and then receipts on new sales?
So this right here, if we take a look at all of this, I have 6109 coming in, 6109 outstanding. So what this is suggesting is already at this point in time, my company has sold $6 million dollars that it needs to collect on. I'm assuming that 100% of those agings are coming in, and some of you are listening to me and saying, that's never going to happen, right? So I might take a look at my AR aging, which any company should have in their accounting system, and I should be able to say, all right, let's take a look by customer, let's take a look by invoice date, let's take a this customer is in fact going to come in the second week, or whether they've been delinquent in the past and we think we're going to get maybe 60% of that. On the new side, these sales of 1.16 are coming in right here. 1.2 are coming in right here. 1.1 are coming in right here. Why? Because I'm assuming a 30-day term. When we take a look backwards, Kirk, and we say, all right, we've got all this outstanding AR, when is that going to come in? That's based upon each one of those customers' terms as well as when those invoice dates were. But going forwards, I say, all right, well, on average, let's assume 30 days. But in the groups that I work with, and they say, yeah, but Carl, you're kind of averaging it out. What if we wanted to do this exact? And I say, no problem. Instead of this being 100% of all of your sales on 30-day terms, you could say, let's do three of these roll forwards. Let's do one for
Hmm.
customer A. Let's do another for customer B. Let's do another for everyone else. And Kirk, how do you think I would determine who is customer A and who is customer B and who's everybody else? Why would I carve out those big two?
Any big customers go and get their own roll forwards.
The big ones, the material ones, the ones that make a whole lot of difference, I want to be able to capture them separately. And Kirk, you might say, we have this giant Fortune 100 customer. We are on 60-day terms with them. We have another customer that's 45-day terms, and then everybody else is at 14-day terms. And I say, well, let's just split the difference. Let's agree to 30. And you say, no, no. Why wouldn't we do the 60, the 45, and then everybody else? That's what we should do is rather than come up with this assumption of just spread everything, is ask yourself if you're going to miss the numbers by spreading and you're okay being wrong, fine. But most companies don't want to be wrong. They need to get this very, very granular. And in some of my clients, I will do a half dozen to sometimes upwards of 20 roll forwards on all of those unique customers. And I
Wow.
can get
Yeah.
all of the sales forecasts from the sales team, all of the terms, all of the AR aging, and this gets really, really precise.
I love it. I have two other questions here that we've
Yeah, go
received.
ahead.
Would now be a good time? Okay, so I got one from Alicia here. We often receive actuals in indirect cash flow structure from
hmm
clients, which makes it difficult to implement direct cash methods. What do you
hmm
do in that case?
Okay, well, what I'm going to bring to your attention is I'm going to bring your attention here to column F. And you're going to see that I have some light blue cells with dark blue font, if I could just say. This right here is AR beginning balance. This right here is AP beginning balance. This right here is accrued payroll beginning balance. This is my payroll on the SG&A side beginning balance. This is accrued PR and marketing fees beginning balance. You get the point here. Alicia and everyone else, anything that is in this column that is blue is coming from the system. So just because you're getting something in an indirect format, I'm just going to say that this actually has nothing to do with the indirect format. This is straight out of your balance sheet, but perhaps deeper, it's out of your trial balance or your general ledger. So this is going to tie into balance sheet accounts. It has nothing to do with an indirect. So don't fret if you have an indirect cash flow, you can still build this if you have the right system in place.
Beautiful. Makes total sense to me, Carl. All yours.
Okay. So now let's illustrate what is actually taking place here. I already showed that these collections on existing AR on the 619 is going to be tied to my AR aging. If I get that out of my accounting system, plug it into my model, I've got a schedule, it's good to go. But over here, I'm going to highlight this. I'm going to highlight this. You can see that this 116, 116, 110, 110, 155, 155, all of this is going 1, 2, 3, 4 weeks later. Why? Because I'm on 30-day terms. Now I'm going to illustrate something really, really important here. I'm going to put my cursor here, and you can see that I have 14.4 million coming in on both of my AR types. New sales, old sales. Now, when I come up here, you've seen that number before. This is all of my cash collections from AR. Why am I not showing old and new? Because I don't need to. My CFO just wants to see how much are we collecting from the AR. But if I'm at 14.4, and what I'm going to do just real quick, I'm going to extend this and I'm going to go equals sum of these two values. There's my 14.4, and I'm going to hard code that number in. I want to watch it. Okay. Now imagine for a moment that I sit down with Kirk, who's my CFO, and Kirk says, you know what? We're really struggling to collect. And I say, well, why? And he says, well, we had somebody leave who is an AR clerk. We don't have the systems that are in place to be able to chase down customers. We also have one major customer that's just paying really slow. And I say, okay. And he says, what's going to be the impact to cash? So if I come over here and I type in, let's say 60, when I hit enter, you're going to see this number move to the right. Do you see what just happened? I'm going to undo. I'm going to redo. This number right here at week 10 just popped. Why? Because it's a month later. Watch what happens to the rest. Copy, paste across. There we go. Now let's hit pause and take a look at what happens. If Kirk, who's the CFO, comes to me and says, we're really slowing down on collections, we've got a real problem. What is this going to do to cash flow? I say, well, Kirk, just in the next 13 weeks, forget about the rest of the year. In the next 13 weeks, our collections are 7.2. Think about the math. 7.2 coming in over this period, it was 14. Why did it get cut in about half? Because it took about twice as long for us to collect. And then Kirk says, well, Carl, I don't think it's going to be that bad. And I say, okay, well, how bad do you think it's going to be? He says, well, let's split the difference. Let's do 45 days. If I come over here, boom, you just saw this pop. It went a couple weeks to the right. Copy, paste the cross. There we go. Our total is now 11.2 versus 14.4. I say, Kirk, the impact to this is a little bit over $3 million. And he says, well, Carl, I got some additional bad news. I say, what's up? And he says, I don't think we're going to collect 100% of all of our sales. So I called myself out before and said, look, I don't think I'm going to be collecting the 6.1, 100% of it. And Kirk says, I actually think that, I don't know, 5% would be uncollectible. Well, remember, this is 11.2. I'm going to take this down 5%, copy paste to the right. It was 11.2. Now it's 10.8. We just lost an additional $400,000. Why? Because on these sales right up here that the sales team is giving to me, I'm saying, well, on average, we think we're going to collect in 6 weeks. 5% of this is going to be uncollectible. So it cuts these collections down and it gives us a real life live picture of what our cash collections will be.
Sounds like I
Okay.
need to do some work as CFO because I'm not doing too hot there, Carl.
And what I hope that all of you realize is everything that you see here in section number 1, this is a templated approach. It's one roll forward for AR. And what I often say to the people who train with me or the companies that I advise is I say, look, grab this, replicate it as many times as you need to. I had mentioned I've sometimes done this as many as 20 roll forwards. Why? Because I might have one customer that's on 45, one might be on 14, one might be on 7, one might be on 60. And if I, again, make these overarching assumptions across the whole company, I might miss. But I'll leave you just this one last rhetorical question. I raise this all the time. As I say, what's the cost of being wrong? You might say, well, if I do one roll forward, I know I'm going to be wrong, but the amount of effort or detail that I need to put in to get six different roll forwards, that seems like a lot. You have to ask your question of how much more detail, how much more precise do I need to get? But last point that I'll add is back to Alicia's question. If this is coming from my AR, from my system, this is coming from my sales forecast. This is coming from my aging. And all of this is just based upon assumptions. It's not a lot of work. All you need to do is use some formulas to connect to the back end to bring your data where it needs to be, and you're good to go. But I would hate to say this, but many of your perhaps average Excel users don't know how to do that. And many finance and accounting people would ask, is there a better way? And you can either use Excel or other systems. All right,
A
now let's
question
come
for
down
you,
here.
Carl,
Yeah, go
here.
ahead,
That's
Kurt.
one that's come in. I got one from Eric, and he said, if we're a cash pay business, mostly, do we need this? And I think he's specifically talking about the DSO.
hmm Well, this is a neat little technique because I'm going to actually put this back to zero. So now we're assuming we're collecting 100%, and I'm going to make days outstanding one. So take a look at what happens. This 116, 116, 12, 12, 128, 128. So all of this is assuming that these new sales are coming in right here. What I don't have, the reason why we still see this balance outstanding, is I am not capturing when these would actually come in. So let's see if I can actually get this formula to quickly update itself. Let's bring these over here. There you go. So what's now happening is this sale gets collected that week. This gets collected that week. So it's basically treating it like it's a cash business, almost like we have no AR. And as you can see here, this 6109 is getting all collected right here. By the time we collect everything in week number 9, it's just a cash business. We have no outstanding AR. And so you can basically go from an accrual business to a cash only business, just like I did in 5 seconds. The reason why I build this is you can create any kind of accounting treatment that you want here. Whether you want an accrual business or a cash business, you've got the same mechanism to be able to do either one.
So would it be fair to say then, Carl, that Eric mentioned that this is a mostly cash business, that he might have two roll forwards, one for his mostly cash side, and then one for the remaining that might have some delayed payments?
Yes, I think that that makes a lot of sense. So you could take this roll forward, create a second one on one instance, make it 1 day, so you can do exactly what I did. And then on the others, make these 30 days. But the last piece, and I actually just got a question about this in my mastermind last week, is one of the attendees said, Carl, not dissimilar is we get cash upfront immediately, and then we get the remainder of the cash, like 80% of the cash, a month later. So it's the same
Mm.
kind of idea is if I get 20% upfront, you need to say this number times 20%, 1 day DSO collected immediately. But then also take the inverse, the 80% of this number, apply it against your 30-day terms, and now you see the collections, collections, collections thereafter. Okay?
Perfect.
All
We'll
right.
have one more
So,
here from
yeah, go
Lucy.
ahead.
She has said, will you be sharing this incredibly beautiful proprietary template?
This incredibly beautiful proprietary template.
I might have
I'm not at
added that
liberty.
wording.
Yeah, I'm not at liberty to share this model, but you will get a template that will be a nice template that you can build off of. And as I had mentioned at the very beginning of our program, I have had people say, I use this to get started. This was very helpful. But I've had a handful of people who months later have said, Carl, this is the basis for our entire cash flow model. So it becomes your choice of what you want to do with it. All right, now let's just do a couple more. There's obviously a whole lot here that we could cover, but let's just do a couple more that are very common. One is going to be accounts payable, and then we'll also just talk about CapEx real quick. So, accounts payable, again, Alicia asked the question, well, we're on the indirect. Doesn't really matter. because this 4.833 AP balance is coming from your system. As long as you can access your system and bring it over here, you're good to go. If I take a look at my payments on AP, here is 4833, 4833. So I am paying down all of my accounts payable, my existing, my aging over these next 9 weeks. But not dissimilar from what Kirk asked earlier is, well, if I segment these, what's the difference? These figures and this figure are what already exists today at this moment in time if I swoop into this company. But in the future, we're going to have all of these additional purchases, right? So if this is an industrial company, I'm going to be buying raw material, 895,000, 959,000, etc. Now I want you to pay attention. This, 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 this. What's the timing? If I go 1, 2, 3, 4, 5, 6, here's that figure. Why? Because I'm on 45-day terms. Now remember, Kirk had said, Carl, I think we've got some cash flow issues. What can we do? Well, I might have a little bit of flexibility to say, well, could we push this by 60 days? Yes, I can. If I put 60 copy paste across, well, this is 2.4. It's still the same. I'm not changing that. But this is now 3.6. All of my cash out is 6 million. If I bring this back to where it was 9 million. So Kirk, if he's my CFO and he says, what can we do to conserve cash? I could say, well, if we can push this by 2 weeks just for the next 13 weeks, I know that we're going to have to play catch up over here, but this is actually going to save us a whole lot of grief in the next 3 months. Okay. So I could say, let's put this to 60. Let's come up here and bring this down, I don't know, to 21. Let's assume that we have pretty good collections. We don't have anything uncollectible, which might not be reality, but let's just assume for a moment. And I come down, look at my reds. Remember, there were a half dozen of them. Now there's one. Right here in week number 3, where I say, uh-oh, I've got 500,000 that's pushing me up. I'm going to come up here and highlight the entirety of what's going on in week number 3, and I'm going to go back to my cash flow. Well, let's take a look. AR collections. All right, it looks like they go down. Is there anything we can do? Maybe we can talk to our customers. Materials, can we push that off? We already did. Payroll, I don't want to delay my payroll. Maintenance CapEx, maybe we could push. It's not going to be a big deal. But this, CapEx, this is going to be our last roll forward that we take a look at. So what I'm going to do here is I'm going to jump over here to CapEx. Now what you can see is I have my cash flow from the other page. I'm going to come back over here and I have all of these 13 weeks. I have these various initiatives, order automation platform for this company, and I got $1 million going out. Now, what I'm going to do is I'm temporarily going to hide this cash flow. Oops. I'm going to temporarily hide this cash flow. And I'm going to take a look at what this sales forecast and direct labor look like, but then also take a look over here. Direct labor original, direct labor recast. Well, why would I be doing this? I want you all to think back to the accounts receipt or to the polling question that took place in the very beginning. Remember, many of you said, I struggle with scenarios. Well, here's a scenario. This is the original one. This is the new one. All of these remain the same until my order automation platform goes live. And if this goes live and I say, all right, well, I want to include this, this is my cash flow. It shows me that I have $3.371 million. If I come back over here, $3.371 million positive. Okay. Now, why you see this negative for the revolving line, I'm actually paying down 3.3 out of the 3.5 of my revolver. Why? Because Kirk was able to keep a whole lot more cash in the business. If I come over here and I say, all right, include, we get 3.3 million, exclude, no, that was not what I wanted to do. Let's come over here. There we go. So here, this shows 4.2 million versus 3.3. Why is that happening? Because I'm not sending out that $1 million. But if I come down and I say, let's take a look at my P&L, this P&L is saying, all right, you've got $274,000 of profitability if you exclude it. But if you include it and I come back, now it jumps up. Well, what's happening here? We're investing $1 million in CapEx. That's cash out. That's hurting our cash flow. But when we come back over here, this is my recast direct labor. This allows me to be able to show this improvement in my direct labor and thus show my improvement in net income. So, everyone, what all of this allows you to see is this is really an integration of your three financials, but it's not financial statement modeling, it's direct cash flows. It allows you to see at a very granular, very precise level what's going on every single week of your cash flows coming in and going out, every single account going up and going down. It allows you to identify where your problem areas are, what your levers are that you can pull and push, how much cash you need, and then you're also able to build, utilize the existing, and go forward on a P&L and a balance sheet. And last piece before we launch our last poll and I turn it over to Kirk is remember all of this tagging allows me to integrate weekly with monthly. So rather than just focus on the next 3 months, Kirk might say, yeah, well, Carl, this is all fine and good, but what happens in weeks 14, 15, 16, and beyond? If I can start this mechanism and start bridging it over here, I can get a 13-week for the first 3 months and a monthly for the 9 months and plus thereafter. Let's launch the last poll and get some of your feedback, some of your thoughts. I'm going to stop sharing here. And let's put up the next poll. So if a major assumption changes, like a customer delays payments, like we talked about here, how quickly can you reforecast? Within hours, within a couple of days, within 1 week, or maybe longer than a week? Take a look. Okay, well, this is good news. It looks like most of you, well, it's going back a little bit. Looks like many of you are able to do this within hours. Not remarkably fewer of you are able to do this within 1 to 2 days. Not remarkably dissimilar within about a week. And then, thank goodness the anomaly is longer than a week. Okay. Looks like people are still entering. Great. All right, Kirk, I'm going to turn it over to you. Obviously, we've covered a whole lot here. There was a lot of detail, but I'm curious from your end, when a lot of people take a look at what I've shared here, there's some really good stuff, but if you don't really understand the ins and outs of Excel, it might be a little bit challenging to do. What alternatives do we have?
Yeah, sure. I mean, I'm a big Excel guy, just to say this up front. I love Excel. It's actually why we've designed Drivetrain to be as much like Excel as possible. One of the things you'll notice whenever you're working in Drivetrain, if, and, or, min, max, right, offset, all of our functions are just DAX expressions. So the good news is if what Carl's showing exceeds 1,084,000 rows, there's another tool out there that can handle that. It's just a bit more online and cloud-based. Now here, you'll notice that the way I've set this up, beginning cash, I've got my cash in, cash out, and other cash movements. So this would be like the first piece that Carl mentioned. But the only difference is other cash movements might be those non-operating things, rarer items, rand, equity infusions, but dimensions, very important. Every company has a different level of dimensionality. In this case, I've broken it up by region and then the customers within those regions. And the reason that's important is because I have some customers that are doing the DSO method, like what Carl's mentioning. They track the DSO by customer and they see that trend over time. And this DSO will obviously fuel that cash in perspective for the future periods. But there's other customers that don't do DSO by customer. They'll do it by region. They'll do it by customer group. Those customers that come through wholesale, those customers that come B2C, B2B, Amazon. Amazon always pays in 14 days, for example. So that makes it easy. But then there's customers that want it a bit simpler, right? Tracking DSO by customer can be tough. So they might do a cash collection assumption on the remaining AR balances. right? And this will all be offset a little bit by DSO, but more categorically. Here I'm assuming 85%. That's in my base case. But if I jump to my high collections case, then I'll have a 95% collections rate, for example, which will filter through to this. Now, to be clear, you might create your models in Drivetrain, but you never present them here. You'll always create a corresponding report that looks something like this. And the main reason is because now I can see my actual, I can see my current plan. I can still drill in as deep as I like, right? In the Americas section here, if I want to see it by customer, I can still go that deep, but it's just nice to see those versions. And then within my current plan, I have three scenarios, those high case, base cases, and low cases I showed you. They're all right here. You'll actually see in the legend, low case, high case, base case. Now, personally, I don't give access to my models to anybody, right? I leave them out of there. So if I do need them to update one of these, I produce what we call a plan table. A plan table is a reproduction of part of the model in the reports. So what I could do is create a workflow here and say, please update Kirk's low case, right? Something like this. Maybe I describe a bit what I want here, assign it to somebody. Let's give it to our CEO, give him a little task. Let's give him till the end of the month. I'm going to make myself an approver, and I'm going to make Ben an approver too. Maybe I give him some instructions. Please review. Now, when he comes in here to create this task, it's already pinged him in Slack, Teams, email. He can now come to the plan table and start editing the values. Now, you'll notice here, I've set this up to be current plan with the high collections case, current plan with the base case, and current plan with the low case. This is a little bit difficult to update. So maybe I just go into the editor here. Let's just switch this around quickly. I'm going to put time underneath this scenario. And the reason I'm going to do that is because now it's just a pivot table. I can edit this whole scenario with a little bit more, maybe Excel syntax, let's just say, with copy and paste across all that kind of stuff. So now he'll come in here, he'll take a look at the current plan, and maybe, he starts fat fingering a couple numbers here. Let's just copy those across. When he clicks save, not only does he get real-time impact here on the kind of visual version of the model, but now that will go back to my original forecast, and he will see that in Kirk's low case as well, which makes life a little bit easier. Regardless, the point is you need something that's going to manage the system, whether that's Excel, whether that's a tool like Drivetrain. You need something that's going to take a look at your 13 weeks and then be able to duplicate it by version, by scenario, so on and so forth. Now, with this, we've got a couple of different questions here, Carl, and I really want your thoughts on this. One is my current model works for a single entity. But as we expand into three new subsidiaries with different currencies and GL structures, the spreadsheet is becoming too heavy to audit. How do you scale an ARAP aging model, breaking it in with a new entity every time it's added?
Yeah, so if any of you have been with me before, I see a lot of actually familiar names in our program. Um, you know that I'm a big proponent of mapping. There's just no way around consolidation if you don't have a clear mapping structure. So even if you have three different business units that are on totally different GLs, you need to aggregate these or roll them up into a level where there can be some congruence. And as it relates to accounts receivable, you might have 200 customers over in this entity, 500 over here, and 800 over here. So they're not going to consolidate across all of them. So you might think to say, well, let's actually categorize the type of customer. It might be by geography, it might be by sector, it might be by asset size, it might be size of account. As it relates to mapping, you might say, all right, well, I've got all of these sub AR accounts. They're not going to map, so roll it up to a higher level of the AR that you can map together. But then the last piece is you might also say, hey, no, I want to preserve the detail. So you might say, let me have detail for everything. When you consolidate it, you might just end up having one very small number because it's on one business unit and higher numbers because it's across three business units. It's just a trade-off between what kind of like aggregation do you want versus detail.
100%. That makes total sense. Now, here, a couple of helpful informational resources for you. Carl's direct cash flow forecast template, not necessarily the one we went through today, but one that Carl can share, that he's allowed to. Drivetrain, we have an indirect one as well. We also have a direct one. That's actually one that I've created. You can find that on our website. Definitely check that out as well. Mix and match. Find the pieces that work for you. 90% of it might be good from Carl's, but only 10% is good from mine. Take Carl's, right? And then obviously right here, we got this course. We'll be sharing these links with you, and we'll push that through to you guys. Other things, right? If, as you're looking through Drivetrain, you'll notice that we launched a poll. I think we're actually gonna to relaunch that one. Feel free to respond to that. If you want to learn more about Drivetrain, we're here. If not, we love hosting these, so please keep coming back. Everything modeling we are a fan of and we love. Let's pause here now for Q&A as well. I want to know if there's anything more detailed that people want to drive into. I've personally got one for you, Carl, and that's this. In your experience, the template that you just showed, very robust, detailed, does it apply to pretty much every company, or are there companies where it just won't work for?
Um, I've used this for companies that are doing over $500,000 of revenue. I've also done this with startups. So the challenge that companies can have is if they are really large with very sophisticated systems, going back to one of the comments or questions asked earlier is mapping can be very difficult. How are you going to use your data to feed something like this? And I'm going to give a very quick example. I was working with a call it a Fortune 300 company a couple of years ago. No, I mean a couple, maybe about 4 years ago at this point. And I remember talking to them about indirect direct cash flow. I was talking to the director of FP&A, and he said, Carl, it's an interesting question. We have been a company, I'm not going to tell you the name or the industry, they've been around for decades. They're a very old company. And like, yeah, we've been doing indirect cash flows forever. They're a public company. And he said, yeah, but we actually just went over to direct. It took us over 2 years
Woo.
to clean up our systems and map it in such a way that we could do a direct cash flow. And I said, well, why? And he's just like, complexity. And I said, well, what's it been worth to you? He's like, game changer. So going back to the question of how do we map, how do we consolidate, we're talking a lot of subsidiaries that need to be mapped. It took them over 2 years to build something like this. And then for a startup that has no detail, recognize that instead of having balances to begin with, it might be you're starting out of the gates, everything is based upon assumptions. Those assumptions have to be defensible. If I were to put this in front of Kirk and Kirk's going to poke holes in what I did, I've got to be able to back it up. But it doesn't really matter the size. Again, Fortune 500 company or Fortune 300 company, startup, most of the companies that I work with are lower mid-market and mid-market companies, and this is such a sweet tool for those businesses.
Amazing. And one last one for me here, and I know we're wrapping up in a couple minutes, but could this process be as simple as downloading the company's bank transactions into CSV and beginning the categorizations of cash in, cash out by operating, non-operating? Could it just be that simple to start that way?
Could it be? Yes. And I hope that everyone who's here does take that to heart of, you know what? You can start with the basics. Might not be great, might not be accurate, but you've got some insight into what transactions are hitting your bank account. That's a start. But what I often say to people is having something is better than nothing. But then having something that is so robust and so difficult to use, if you're not going to actually use it, that's pretty worthless. So I try to meet in the middle of, Kirk, I want to take a look at your bank statements. I want to take a look at your accounting. I want to sit down and I want to interview people. I want to take a look at your existing financials. And I'm going to take my model and craft it so that it matches your bank statements, your financials, your account structure, etc. And the last piece that I'll add is what I didn't go through in our program here is all of this is dynamic. So if I were to just really, really quickly share my screen and come back over here,
Definitely.
and I put my cursor here, all of these are all dynamic formulas. They update themselves. So most people will not model this way, but it's just this evolution of start with what you got, get a little bit better. This is a long-term marathon of what can we do better from the last version.
Beautiful. So, guys, the poll's up right now for 2 more minutes, I guess, while we're here. One more question for me, Carl, and actually, Greg Monroe has just asked this. This is a huge debate in the cash flow world. True or false? Indirect ending cash balance should equal direct ending cash balance. How much can you make these two work together?
Cash is cash. It shouldn't matter what method you're using. Net cash flow is net cash flow. It doesn't matter what method you're using. The challenge that I've had forever for the last 2 decades plus is to reconcile an indirect to a direct above your cash flow is not necessarily easy because remember, the indirect is just movement on your balance sheet and net income. But your direct is taking a look at all of that activity that I had down below in the roll forwards. So cash is cash. It should be the same no matter where you are. If you use a balance sheet that's driven by your cash flows, it better be the same. Your net cash flow better be the same. But all the reconciling items up above, sometimes it looks a little bit mysterious because you can't always reconcile. But you build that right, your bottom number should all equal.
Phenomenal. Well, guys, thank you so much for joining today. We really appreciate you checking in. There are CPE credits. We do have all those links, so definitely follow those. Email us, either of us, if you have any questions. Carl, thank you again for sharing your wisdom with us.
You're welcome. Thank you all for being here. Great to see you again, Kirk.
You bet. Bye, everyone. Thanks again.